How credit card debt grows faster than you think. Many people believe credit card debt grows slowly, but what most people don't realize is that credit card debt uses the same force as investing, compound interest, just working in the opposite direction. That's why balances can grow much faster than expected. Section 1. What credit card debt really is. Credit card debt is money borrowed from a lender that comes with interest. When a balance isn't paid in full, interest is added to the amount owed. That interest doesn't disappear. It becomes part of the balance, and future interest is calculated on that higher number. This is where compound interest comes in. Instead of money growing in your favor, it grows against you. Understanding this process helps explain why credit card debt can feel overwhelming over time. Section 2. Simple interest versus compounding debt. With simple interest, interest is calculated only on the original amount borrowed. Credit card debt usually doesn't work that way. Most credit cards calculate interest on the current balance, not the original amount. That means interest is being charged on interest that was already added. Each time interest is added, the base number grows slightly larger. Over time, this repeated process causes the balance to grow faster than many people expect. This compounding effect is subtle at first, but becomes more powerful as time passes. Section 3. A simple credit card example. Let's look at a simple example. Imagine a $1,000 credit card balance with an annual interest rate of 20%. If no payments are made, interest is added regularly. After 1 year, the balance grows to around $1,200. In the second year, interest isn't calculated on $1,000 anymore. It's calculated on the higher balance. That means interest is being charged on interest that was already added. Each time interest is added, the base number grows slightly larger. Over time, this repeated process causes the balance to grow faster than many people expect. This compounding effect is subtle at first, but becomes more powerful as time passes. Section 4. What happens when small payments are made? Now let's add payments to the example. Many people make payments each month and assume the balances shrink quickly. However, when payments are small, a large portion often goes toward interest. This means only a small amount actually reduces the balance. When interest continues to be added, the balance decreases very slowly. In some cases, the balance may barely move at all. This creates the feeling of making progress while the debt remains mostly unchanged. This explains why credit card balances can last for many years when only minimum payments are made. Section 6. The role of compounding frequency. Credit card interest is often calculated daily or monthly. The more frequently interest is applied, the faster compounding occurs. Daily compounding means interest is added in small amounts many times throughout the year. While each addition seems minor, the cumulative effect becomes significant over time. This frequent compounding is a major reason credit card debt grows faster than many people expect. Section 7. Why credit card debt feels manageable at first. In the early stages, credit card debt can feel manageable. Balances may increase slowly and interest charges may appear small on statements. Because compounding works quietly in the background, the impact isn't immediately obvious. This delay can give a false sense of control. By the time the compounding effect becomes noticeable, the balance may be much higher. Section 8. Time is the biggest factor. Just like with investing, time plays a major role in how debt grows. The longer a balance remains unpaid, the more opportunities compounding has to work. Early on, changes may feel small. Later, growth can feel sudden and overwhelming. This is why credit card debt often becomes harder to manage the longer it exists. Section 9. Why credit card debt grows faster than savings. Savings and investments can compound, but often at lower rates. Credit card interest rates are usually much higher. This means debt can grow faster than savings grow in many situations. When interest rates are high and compounding is frequent, debt accelerates quickly. Understanding this difference helps explain why carrying balances can have a strong long-term impact. Section 10. The psychological side of compounding debt. One challenge with credit card debt is that compounding is not easy to feel. Interest charges are often listed as small numbers on statements. This makes it easy to underestimate their long-term effect. Because the growth happens gradually, it often goes unnoticed until the balance becomes difficult to manage. Understanding the math helps make the process more visible. The core concept to remember: credit card debt grows faster than expected because interest compounds on an already growing balance. High interest rates and frequent compounding amplify this effect. Even when payments are made, progress can be slow if most of the payment goes toward interest. This doesn't mean the situation is hopeless. It means the math behind credit card debt is always working in the background. Recap summary. Let's quickly recap. Credit card debt uses compound interest, meaning interest is charged on both the original balance and previously added interest. High interest rates and frequent compounding cause balances to grow faster over time. Minimum payments often slow progress because most of the payment goes toward interest. The effects of compounding may not be obvious early, but become stronger later. Understanding how credit card debt grows helps explain why it can feel difficult to escape. If you liked this content, please like, comment, and subscribe.